The share price of CINEWORLD has dropped 93% in the last year, falling 80% in the most recent week alone. From an all-time high of £84.8 a year ago, it now trades at £2.75. Now I have to take into account all the current events to determine whether or not buying CINEWORLD shares would be a very bad decision for a long-term investment portfolio. What's good, you guys? This is Market Thrive, and today, we're going to be talking about CINEWORLD and why you should avoid buying its stocks. Before we start the video, I would just like you to do me a favor by just hitting that subscribe button and the bell notification down below to keep you updated on this channel. So without further ado, let's hop into it. The majority of individuals, I believe, were aware that the company had been having trouble ever since the pandemic began. People were banned from visiting the movies due to lockdowns. Even after the company's sites reopened, many people were hesitant to enter a room with a lot of strangers again. The development of online streaming services over the past few years and delays to big-budget movies have both hurt CINEWORLD. More debt has been accrued in order to survive and deal with a cash burn rate. Sadly, it was confirmed towards the end that the company is thinking about filing for Chapter 11 bankruptcy in the US. When a business wishes to keep operating but needs some time to get its finances in order, this sort of legal action is taken. Therefore, despite the fact that this is currently considered to be business as usual, many investors view it as a serious warning sign, which accounts for the sudden drop in the share price. Many films are being released directly to streaming sites, but this also implies that films that are shown in theaters can be made available there within a few weeks. If you recall from before, it used to take a while for them to appear on streaming services or DVDs, which essentially meant that people who were genuinely interested in watching movies would visit the theater to do so. However, nowadays, many would rather use streaming services because it's much simpler to obtain the legal versions, and they may wait for them rather than really going to the theater to view them. So in my judgment, that one significant adjustment had a significant impact on the firm. The UK government was also notably unsupportive of the leisure industry during the CV Times incident. Then when they finally did open, there were a lot of mask mandates on them, which essentially meant that through 2020 and 2021, due to the CV situation, a lot of leisure complexes were only operating for 8 weeks starting in March 2020. And even during those 8 weeks, they were severely restricted by distancing rules and other restrictions. As a result, the government didn't really help the situation either. Resuming our current situation, many people witnessed a decline in CINEWORLD yesterday. You're looking at a sector of the economy that, in this situation, is struggling in my judgment. They are suffering with growth, with profits, and with the balance sheet, which is in a really bad condition. They essentially stated that there have been fewer levels of admissions, which means that they are not generating the money they had hoped for. Obviously, this will also likely have an influence on their profit margin. A constrained film schedule they did acknowledge was the cause of this. At this point, as I consider the situation, I believe there was a significant backlog of movies and a desire for movie-going. At the moment, I can think of the 3 major releases: the new 4 films, the new Doctor Strange feature, and the Top Gun movie. It's kind of expected that the Top Gun movie will be popular because I know that many people have been eager to watch it. CINEWORLD, however, claimed that they required additional liquidity. In essence, it means that they must find a source of funding for their demand for money. The frightening part is that if they don't acquire money from somewhere, they're effectively going bankrupt. And the difficulty is, even if you do acquire the capital with the risk that you have will come with very high interest rates because everyone knows you need capital, but you're already buried in debt. Therefore, even if they succeed in getting through and receive the additional funds, the terms will not be good. That's why it's a very scary situation right now. The balance sheet for this company has only been getting worse since the 2017 time period, according to their balance sheet. As of right now, they have $5 billion in debt, which is absurd considering that the company has a market worth of $100 million. In 2018, there was a lot of debt taken on, and over the last 2 years, that debt has only risen. They also had $354 million in cash on hand, according to the balance sheet. We don't know exactly how much money they're using right now, but their cash burn rate is pretty significant, and the organization is burdened with a sizable amount of debt. And if we're to take a look at the analyst predictions, They really predict that they will achieve profitability in 2023, but they also predict that they will continue to lose money. They are already burning through 500 million, which is concerning because they were doing the same thing last year. The burn of cash is therefore very high. The cash amount on that balance sheet is extremely low, while the debt level is extremely large. They do require capital, and one of the businesses in this area claims that they're only doing trade poorly. As a result, this is perceived by many as a move with high risk and potential return, because you're entering a sector that is currently experiencing severe hardship, and the company is open about the fact that you're not purchasing a company that is actually beginning to develop in a favorable way. As what you can see here, in my opinion, this is a very risky choice. I believe that there are many elements at play here that make it inappropriate for you to be involved in this business at this time. I think the risk is too great, and as I stated, many individuals are only interested in the potential rewards. But you also need to consider the risk in this situation. Don't misunderstand me. I say this now that it has been priced in. Anything can happen to that share price in the near future. Perhaps a week or two from now, but you never know. It might go a little bit wild. People attempt to play that risk, and it might work out. But you need to consider the risk. What is the danger of them failing to succeed and cross over? It is, in my opinion, a considerable sum. It's definitely higher than 50% in my opinion. I would estimate that the odds of this firm failing within a year are probably about 80%, which is obviously way too dangerous for me. So the question is CINEWORLD a buy, or is it in danger of failing? Unfortunately, I would argue that this is not something you should buy. I believe the risk is far too great. And regrettably, I believe that at this time, bankruptcy is more likely than not. Don't get me wrong. I hope everything works out for the company and would never wish for it to fail. And if there are any stockholders watching this video, I sincerely hope everything works out for you. But in my opinion, you would be taking a very significant risk here, and the risk to reward ratio is not on your side. With a debt of $5 billion, this is pretty significant. Even if it had some debt on the balance sheet, the scenario might have been different. But the industry isn't one I'd recommend getting into at the moment. So you guys still thinking about buying CINEWORLD stocks? If you like today's content, you'll sure love our previous video about Netflix, which you can find in the description below. Feel free to jot down your thoughts in the comment section below. If you enjoyed today's video, please leave a like. And if you want to stay updated in our posts, hit that subscribe button as well. Once again, this is Market Thrive, signing off.